Welcome back, everyone, to the channel. I wanted to get this video out there today to talk about FDIC Insurance, the Federal Deposit Insurance Corporation. I don't even know what FDIC stands for, but close enough. We see the stickers every time we walk into a bank. The FDIC. What does FDIC stand? Federal Deposit Insurance Corporation. There we go. Now we know what it stands for. But what I want to talk about is that everybody knows FDIC insured. They drilled it in our heads for the last 30, 40 years. FDIC insured. Make sure you deposit at a bank or FDIC insured. It's this false sense of confidence that you have the safety net that if you fall, that this is going to catch you and make sure that all of your currency is safe and secure. Well, I'm sorry to tell you this, but this insurance is more of a fraud than a reality. Let me go into it. Let me share my screen real quick. There's not much for me to talk about here, but I'm going to go straight to the FDIC page itself, and let me try and zoom in a little bit more to make this a little bit more legible. All right. So here's the FDIC page itself. The FDIC, this is from October 2022. The FDIC adopted a final rule, blah, blah, blah. They also currently maintain the designated reserve ratio, or DRR. They love acronyms. For the DIF, which is the designated deposit insurance fund. I think that's right. At 2% for 2023. So they're shooting for, I'll continue reading, I'll explain it. The increase in assessment rate schedules is intended to increase the likelihood that the reserve ratio of the deposit insurance fund, or DIF, reaches the statutory minimum of 1.35% by the statutory deadline of September 30th, 2028. Now, I'm going to hold off on reading that last statement here, but 2028, right? They're saying that this will happen in 5 years, 5.5 years, September 2028. Now, I don't know about you, but I don't count on anything being accurate more than a couple months, okay? 5.5 years, this is their target. This is what the government often sets as their goal. And it's kind of like a wish list. They said when they propose a new budget, they do this or do that. They almost do what's called like a pro forma, which is like, this is how we expect it to play out for the next 5 to 10 years. It never plays out that way because they make bad assumptions, but that's how they spin this story, the creative narrative to say, hey, if we do this, we're going to save $50 billion or $3 trillion, whatever the number is, and spin it with all these rose-colored glasses they put on before they issue that report and tell you how it's going to be. Well, what really happens is that things change the next 5.5 years or whatever, which radically change the outcome of that pro forma plan, because pro formas never are accurate. Ask anyone that goes before a venture capitalist, and if they say, what are your real sales versus what's your pro forma sales? Pro forma is a wish list, pie in the sky. If we get 1% of the market share, we'll be able to do this. That never plays out that way. So let me go back to sharing that screen and talk about a little bit more here. So at the end of this highlight, here's the highlight in the orange here. Extraordinary growth in insured deposits during the first and second quarters of 2020 stimulus caused the DIF reserve ratio, calculated by dividing the DIF balance by dollar amount of insured deposits in the banking system, to decline below the statutory minimum of 1.35%. What does that mean, Jeff? Okay, so they have a target of 2%. Let's start. You have the DIF and the DRR. So the DRR is a ratio of the deposits that they have in all the banks that should be insured versus how much they've set aside the reserves for insurance. So they're saying in an ideal world that it's 50 to 1, 2%. For every $1 million or every $15 million of deposits, they have $1 million allocated for a reserve as an insurance policy because they don't expect more than 2% failure of banks. Okay, I can buy that. Let's move on. That's okay. But now, when you read further, based on the actions and what's happened, the events of the first half of 2020, we all know what happened then. There's a lot more deposits on the books. Why is that? Well, I think a certain government issued a lot more currency over that time frame and tried to stimulate the economy. So because of that, a lot of that money, a lot of that currency went up in banks and bank deposits in FDIC insured accounts. which rose the number of deposits without raising the amount of the insurance. So now the ratio is going out of whack. If we had 50 million deposits and 1 million of insurance, it's now like 75 million to 1 million. So now it says 50 to 1, it's 75 to 1. So that ratio, that what they were saying in that document was that they're trying to get it to 1.35%, which means 1.35%, that's about 5%. 1.3 is for 25. So yeah, 75 to 1. That's 75 to 1. So basically 75 to 1. So you've gone from 50 to 1 to 75 to 1, and that's a stretch goal, which means that's not where they're at now. So it's probably like 80 to 100 to 1 right now, which means that boiling it down, if you have $100,000 in the bank and you think you're safe because you're under that $250,000 limit, theoretically, yes, you have an insurance claim, but that doesn't mean you will be made entirely whole. What you will likely get is 1 to 2% of the original funds in US dollars, and then you'll be able to redeem probably something. Now you may be given an option because they are at a point, it's a critical point, critical juncture in the timeline for the current financial system. It would not surprise me at all that some entities, be it individuals or businesses, are offered, if they're not below the FDIC. Okay, let's start with an individual below FDIC line. You may be offered an alternative currency rather than getting dollars back if you're not made whole. Same thing may happen for accounts that are above the FDIC line. So let's just say a bank that goes under with $200 billion in there and only $5 billion are insured. Let's just call it $200 billion. It's uninsured. Okay. How are you going to make people whole? Are you going to print $200 billion of US dollars onto the account and add them to your books? Or are you going to give them an alternative to say, you could take that $200 billion in USD, like dollar bills, or you can take it digitally as part of a central bank digital currency that we're launching, and you'll get them in May or June. They may do that. They may try and put these CBDCs in the hands of these companies, and this could be a path that these particular banks that failed may be paths to get those people. You may see a lot of Cantillon effect going on, where we've got people that are getting the first ability to get CBDCs because of that bank failure. So it's possible that accounts may be redeemable for CBDCs at a better rate than they would get if they were just trying to get dollars back. So if you're holding your breath for FDIC insurance to save the day, it's not going to happen. But the Hegelian dialect: problem, reaction, solution. Giant problem, banks are going under. The reaction: Federal Reserve meets on a Sunday, which never happens, and says, we're going to step in and intercede. Solution: wait for it, could very well lead to CBDCs being launched sooner than you expect. So I hope this added some context and helped out. I would love to read all your comments. Please like, share, and subscribe to hit the notification bell. Helps out the channel. With all that said, I'm going to close the door in the bureau, say follow leader one more time, and I'll talk to you soon. Take care.